If you like the content, give it a like, smash the notification bell, and consider subscribing to our channel. Be the best version of yourself. Credit card delinquency happens when a borrower doesn't make at least the minimum payment by the due date. Typically, accounts become delinquent 30 days after a missed payment, negatively impacting credit scores, raising interest rates, and leading to late fees, or even debt collection. Managing credit card delinquency quickly can protect your credit and keep financial issues from escalating. Causes and consequences of credit card delinquency. Common causes of delinquency include unexpected expenses, overspending, or lack of budgeting. Once delinquency starts, it can lead to credit score damage. Even a late payment can significantly lower your score. Penalty interest rates. Missed payments may trigger a higher APR, annual percentage rate. Late fees. These accumulate quickly, increasing your balance. Potential legal action. In severe cases, creditors might pursue legal measures to recover unpaid balances. Steps to address credit card delinquency. Assess your situation. Review your recent statements to see the overdue amount, late fees, and interest rates. Knowing the full scope of your situation helps you choose the right solutions. Contact your card issuer. Many credit card companies offer hardship programs that can lower your interest rate, waive fees, or extend your payment deadline. Contacting them early and explaining your circumstances can often prevent additional penalties. Make minimum payments. If paying off the entire balance isn't possible, aim to pay at least the minimum amount. This will prevent your account from becoming overdue and stop late fees from stacking up. Setting up automated payments helps ensure you won't miss future payments. Create a repayment strategy. To tackle multiple delinquent accounts, try either the avalanche method by paying off cards with the highest interest rates first, or the snowball method by paying off the smallest balances first. Both methods help reduce your overall debt effectively over time. Look into balance transfers. Balance transfer cards with low or 0% introductory APR offers can give you room to catch up. Just watch for transfer fees and ensure you can pay off the balance before the introductory rate ends. Consider debt consolidation. Consolidating credit card debt into a single personal loan can lower your interest rate, simplify your payments, and reduce your monthly costs. Build a budget. Track your income and spending to set up a realistic budget. You'll have more funds to apply to debt by identifying areas to cut back. Budgeting apps like Mint or YNAB, You Need a Budget, can be helpful tools for tracking expenses. Explore credit counseling options. Nonprofit credit counseling agencies offer free or low-cost advice. A counselor can work with you to develop a debt management plan, DMP, negotiating lower interest rates or reduced payments with creditors. Long-term debt reduction strategies. If your goal is to regain financial stability, focus on these additional steps. Reduce non-essential expenses. Temporarily reduce luxury spending to free up cash for debt repayment. Increase your income. Consider freelancing, a side gig, or part-time work to help pay down debt faster. Apply windfalls, use bonuses, tax refunds, or financial gifts to reduce your credit card balance rather than spending them elsewhere. By taking these proactive steps, you can catch up on delinquent payments and lower your overall debt, giving you greater financial control and improving your credit score. Thanks for watching. If the content was valuable, consider subscribing. Until next time, keep reaching for the stars.